capital gains and capital losses and the tax implication and tax planning. So what is a capital gain or a capital loss? So a capital gain or a capital loss occurs when an investment property is sold. So whether that is through an individual owner, a company, a trust, when you sell, and it's important, not when you buy, but when you sell a particular investment property, that creates a CGT event or a capital gain event or a capital loss event. Now, the one important aspect to note is that in the event of you selling your own primary place of residence, there is no capital gains tax as of today. Now, what changes might come in the future, no one knows. But today, if you have a house that you've lived in you've lived in as long as you've owned the house, and it's never been rented out or never been treated as an investment property, and you sell that house, then there is no capital gains that's applicable to that particular sale. Now, when we think about capital gain, there are two events that can occur. One is we incur a capital gain or we incur a capital loss. A capital gain means that when we sold the house and we compare that sale price to the purchase price and other relevant expenses, and we'll talk about what those other relevant expenses are, then if we've sold it for more than what we've bought it for with the relevant expenses, then we have a capital gain event. So let's say I have purchased a house for $800,000 and I have sold that house for $1.2 million after I factor in, and in that purchase price we'll factor in all the relevant expenses. I've made a profit, so to speak, or a capital gain of $400,000. Now, there are specific rules that guide how that's treated, and we'll talk a little bit about that in this module, but that's basically what a capital gain means. If I have purchased a property and I have sold that property for less than my overall expenses, i.e. the purchase price, stamp duty, and other relevant expenses. An example would be I purchased the house for $800,000 with all relevant expenses, but because of a downturn in the market, I sold it for $700,000. Then I have a loss of $100,000. So we'll talk about what capital gain means and the way it's treated, what capital loss means and the way it's treated. The other important aspect to consider is when we say and when we do the calculation of when a particular property is sold, and this is again where we go back to what we were saying earlier, we want to get the right experts who understand the theory and the application of it to actually, conduct the accounting behind any capital gain event. But basically what happens is you've got a sale price, and from that sale price, you deduct the original purchase price, you deduct the stamp duty, you deduct the cost of property improvement that you might have undertaken, you deduct cost of sale. You've also got to factor in the cost of capital work deductions, which need to be deducted for any depreciation claim. So remember how we spoke about capital expenses of 2.5% to 4%. So if you have capital expenses that you have depreciated, meaning you've taken an expense benefit of 2.5% or 4% throughout the year, you can't double up on those same depreciation expenses when you calculate your capital gain or capital loss for that matter. So it's very important to factor all of that in, which is why the calculation itself is extremely, extremely important. And so those are the types of expenses that fall within that calculation. It's not a simple, I bought for X and I sold for Y. There is certainly a lot more nuance to that and the way that calculation is constructed. Now, usually capital gain events when it comes to investment properties, at least in Australia, are significant because the property market has grown sizably. And if we just look at from 2000 on to 2025, there's been tremendous growth. Doesn't matter where you are, what city you're in, the growth has been significant. And so we're talking about large sums of money. And so it's very important that it's calculated in the most effective way, because if you're missing something out, you're potentially missing out on an opportunity in the sense that you might be paying more capital gain than you should. And vice versa, you might be claiming something that you're not eligible to claim and therefore find yourself in a position where, you're penalized down the road as a result of making those incorrect assumptions and claims. And so that has to be considered. Within capital gain, there's also the notion of a 50% discount. Now, what that means is in Australia, there's a particular rule that is referred to as the 50% CGT discount, although we have to be mindful of the percentage. The percentage applies, the 50% percentage does apply to individuals. It applies to trusts under certain circumstances, not to companies. But there is a different percentage that applies to self-managed super funds. The reason for that is self-managed super funds have a different tax rate that governs them, but that's a separate topic without getting into too much detail. But the CGT discount basically works in a very simple manner, and it states that if a property is owned by more than 12 months, then there is a 50% CGT discount. Now, this applies to individuals and it applies to trusts under certain circumstances. And so what that means is if I as an individual have purchased a property and the total cost with all the expenses is $800,000 and I purchased that property 3 years ago, I sell that property for $1,200,000 today, as an example. I've held the property, so the rule for a CGT discount is that it has to be held for more than 12 months. In this case, I've held it for 3 years, therefore that rule applies. And the way it's calculated, if I sold it for 1.2 on the back of an 800,000 purchase plus expense price, then I have a capital gain of 400,000, but I get a 50% discount and my capital gain becomes 200,000, and it's on that 200,000 that I'm going to pay tax. In this case, I'm the individual owner of the property, so therefore the tax applicable would be the relevant tax bracket that I fall within for that particular financial year. It might be with a $200,000 capital gain, I'll be hitting the higher tax rate, at least a portion of it, plus if I've got additional income. But without complicating the matter, that's the way it would work. Trusts also have the benefit under certain circumstances of a capital gain discount. Companies don't. But companies, a small company is going to pay 25% tax anyway. So it's a lower tax rate than what an individual would pay if they ended up with a significant capital gain in terms of a long-term sort of structure. But again, that depends on each individual case and their overall position. So there are factors to consider. So just to recap in terms of the rates that are applicable, an individual will pay capital gain if the discount applies. Based on their bracket, the company will pay based on the company rate, and the trust will allocate or distribute that relevant capital gain, and based on the beneficiaries that it distributes, they'll be liable for the tax itself. This is why when we create a trust, it's always good to create a trust that has a corporate trustee and that has a set of individual. So if it's a discretionary trust where we've got family members as part of being part of the beneficiaries, we also create a corporate beneficiary, meaning a company can be a beneficiary in the event that the individuals have a very high tax bracket that they've reached in their income levels. We can then allocate to the corporate beneficiary, which is going to limit the tax rate to 25%. But again, this is part of the overall strategy of when we're thinking about investing in a property and what it means long term, which again, I refer always to please buy the best advice that you can, because it'll make a significant difference of where you end up financially. The other aspect of capital gains is capital losses. So this is where we've incurred a loss and individuals carry forward that loss. So unlike a capital gain that's taxed at the individual bracket level, if I've purchased a house and we use the same example, my cost was $800,000, but the market had a negative turn and I sold it for $700,000, I have a capital loss of $100,000. I cannot, and this is a key aspect, I cannot use that loss to offset other taxable income. Rather, I carry that loss forward as an individual until such time when I have a capital gain event to offset it. So let's say I've lost $100,000 on this house, but I've got another house that in 2 years' time I sell, and that house makes a capital gain of $100,000. Technically, I would pay tax on that capital gain, but because I have this loss that's being carried forward, it would offset that capital gain and bring it down to zero. Companies can also carry forward losses. The same applies to trusts. The other important aspect to note, although would not apply to most of us, is that if you've purchased a investment property prior to 1985, which is the year when capital gains was actually introduced, then you are likely to not be subject to capital gains. Now, there are certain aspects to that, but generally you'll not be subject to capital gains at all. Unfortunately, I was born in 1986 and only came to Australia in 1995, so I had no hope whatsoever, but maybe some of you watching this might have that benefit. But any property, investment property that was purchased post 1985 does attract capital gains if on the back of the calculation itself there is a capital gain or subsequently there is a capital loss.